The impact that those China numbers had when they came out about 1 p.m.
James, it was all about the China numbers today, and that's because it was such a quiet session today. About $3 billion worth of stock being traded, with the US on holidays tonight for the Martin Luther King holiday. So if we have a look at the market, we did see the China numbers coming out at 1 p.m. and we saw GDP growth of 7.7% in the fourth quarter of the year. And just to put that into context, you know, that's almost half of what we saw in 2007, where China was growing at 14.2%, and 2010, where China was growing at 10.4%. So if we have a look at the Chinese stock market, we've seen a similar pattern in terms of the Shanghai Composite, and also because of the global financial crisis, with the Shanghai Composite peaking in 2007 and of course really having a tough session. So we've seen Chinese GDP growth, the lowest in around about 19 years, but of course it's all about market expectations. The market was expecting 7.6% growth, so the numbers actually coming in higher than what the market expected. In particular, we saw an uplift in the materials space. If we have a look at the material index intraday today, this is what it looks like, and you can see that if I just change it to the intraday graph, what you'll see is at 1 p.m. we did see the materials index shooting up. So it was good news for the miners. It was also good news for the energy and the industrial sectors, which slipped back into the black, and the financial sector also saw a lift. So if we have a look at the financial space, from 1 o'clock we saw a gradual if I just change that to an intraday graph, we saw a gradual increase in the financial space as well. So those China numbers, good news for the Aussie market. Although we were down 0.2% at the end of the day, during the session we were down as much as 1%.
The profile of the growth over the next decade in China is going to be different to the past decade, and as such, people should be looking at investing in different areas as a result.
Absolutely. We know that China's concentrating on internal growth rather than from exports, and that's going to be a shift that happens over the next decade, and that's going to probably add to a bit of volatility in terms of growth as well. But some of the numbers that we are watching in terms of China is how much steel is being produced and the demand for commodities. And if we have a look at steel production in 2013, it still remained very strong. So that's still supportive of some of the key commodities on the Aussie share market, especially iron ore, and that's of course reflected in the Port Hedland statistics that we've been seeing and the fourth quarter production numbers that we've been seeing as well. So China still has a big impact on Australia, especially seeing that international investors do look at Australia as a way to get exposure to that Asia-Pacific region growth. So unfortunately, we do still have some very strong ties there, but as China does shift to look at more internal growth rather than growing externally, I guess the focus will be more on volumes coming through from those key commodities that the Australian market is exposed to.
We get the big players on our market. Woodside Petroleum, we've seen a little bit of weakness. We've seen Shell in the headlines the last few days. It obviously holds a reasonably sizable stake in Woodside. I mean, are we drawing parallels between Shell's issues and potential weight on Woodside's share price?
I think Shell's issues are different from Woodside Petroleum. Woodside Petroleum came out with its fourth quarter numbers, which were very well received, but we are seeing weakness in Woodside Petroleum's share price, and that's really because of instability in terms of future plans for Woodside Petroleum, because Shell is not only a major shareholder with a 23.6% stake in Woodside Petroleum, but also key stakes in many of its projects. It's got a 1/6 stake in Northwest Shelf, 25% stake in Gorgon, a 27% stake in Sunrise, and 9% stake in Browse. So some of these projects, I guess a bit of a question mark on whether Shell is going to continue to fork out cash for these projects, given that we did see the December quarter numbers pretty much almost half what they were around a year ago. The other project which is in focus is the Arrow Energy, the $20 billion coal seam gas project, because of course Shell owns a 50% stake in Arrow Energy. So just watching that as well, and we're also watching the Geelong refinery. I know it's already been flagged for a sale, but we just may see that sale come a little bit ahead of schedule as Shell looks to divest those investments in the, I guess, just looking at its profit numbers, which were quite dismal. So just probably looking to speed up those divestment plans, and that uncertainty leading to weakness in Woodside's share price.